Without further ado, let's get started tonight. How to trade volatility and the VIX with myself, Don Kauffman. This is a TheoTrade presentation. A few things we throw up front. Risk disclosure. We are not financial advisors or a broker-dealer. The reason we always mention this and throw this slide up over here, the previous 15 years of my career I did spend in, that side of the industry with thinkorswim and, of course, TD Ameritrade. Also, copyright disclaimer, this is ours, this is not yours. If it wanted to be yours, well, you could, of course, see the replay. Nevertheless, contact us, support@TheoTrade.com. That's me, a little bit about me. Again, my name is Don Kauffman. I welcome everybody this evening. I'm the co-founder here of TheoTrade. I got my start in the options business, Florida Chicago Board Options Exchange. I was a derivatives risk manager, and very shortly after I started in my trading career, and I came from a family of traders. People, how do you get started in the trading business? I kind of grew up around it. So pretty much at the ripe old age of 22 in the late 90s, I was invited to initially clerk in Chicago. I ended up trading shortly thereafter. About 2 years after my start in the industry, I was invited to a little no-name firm, and the no-name firm happened to be called thinkorswim, and was there from almost the very beginning until the point where we ultimately took the company public. It was a good deal. TD Ameritrade eventually acquired thinkorswim a few years thereafter. I spent 5 years at TD Ameritrade running their entire education division for ultimately 7 million clients. In fact, one of the other instructors here at TheoTrade, Jeff Bierman, worked alongside me for 8 of those years. So it's been a long career on the brokerage side of the business. By the way, on the brokerage side of the business, spent time, of course, trading. In the early startup years of thinkorswim, it wasn't really any salaries. We traded. It was, trade to eat is what we used to call it. A little bit about TheoTrade. So at TheoTrade, we specialize in education for stocks, options, futures, and we trade everything seamlessly. Okay. And it's important to know that. I know a lot of people, they specialize here, they specialize there. Listen, if you trade options, you can buy them or sell them. You trade futures, you buy them or sell them. You trade stocks, you can buy them or sell them. And to me, that's, what trading happens to be. Now, all of the trading educators here, all the instructors have a minimum of 15 years of specific industry experience, many with a couple of decades over there. And we were initially designed here at TheoTrade to help you mitigate the risks in the market. And again, the skill set that we're going to very much talk about tonight is a skill set that will last you for a lifetime. I think you guys will love what we are going to be discussing, of course, this evening. So with that, a lot of people kind of ask, like, who is TheoTrade? And not just what's a TheoTrade, who's TheoTrade? So it's not just myself, Don Kauffman, it's Doc Severson. Anybody know Doc? So Doc's actually based out of Ohio. Has been a trader for many years, stocks, options, and technicals. Jeff Bierman, as I mentioned, he was the former chief market technician for TD Ameritrade. We've got Slim Miller, 43-year veteran. He actually started on the Chicago Board Options Exchange, now specializes predominantly in stock and futures trader. Last but not least, Tony Rago, a NASDAQ futures, and he's really an intraday strategist. So along with me, there are 5 full-time instructors here now at TheoTrade. Moving on, what you're going to learn in this presentation. So really important, we're going to talk about the VIX a bit. And the VIX tends to be a little bit of a mystery. And I think a lot of people would probably agree with that. They kind of think they know what the VIX is, but the VIX is very much a mystery. And we're going to try to, clear that cloud up a little bit. So we're going to learn about trading volatility and how to create volatility-based trades. It sounds easy enough, and I'm going to cover that here right up front. We're going to see really how a detailed understanding of volatility can provide advantages in really all the trading strategies that you may encounter. A better understanding of volatility. And some of that, I'm going to go a little bit off the cuff tonight, a little bit off the beaten path. That all right with everybody? And listen, there's a lot of people tuned in here. Some people are going to be watching this in an archive. And when I say I'm going to go a little bit off the beaten path, hope you don't mind. You know, I like to go a little off the rails from time to time. We're going to discover how trading specifically VIX options can help reduce your portfolio IRA or 401k risks. All right, so I paused there already for a second. Reduction of risk, reduction of risk. Now, we're going to talk about a specific strategy here tonight that can help reduce risks. But at the same time, you might say to me like, listen, I don't have much of an IRA or 401k, or, I've exited a lot of my risk already, which is fine because the exact same strategy can be used, all right, ultimately for profit potential. And the strategy we're going to talk about this evening, it's being used right now by the largest trading firms on the planet. Okay, hands down. I mean, trading firms are using this strategy and trading millions of VIX contracts. I will show you the open interest in some of the VIX over there. And what are the right steps to take, whether you're trading or investing? And there's a big differential. Some of you guys are investors. You just want to learn how to mitigate risks of 401k, IRAs, portfolios. Some of you guys are actively trading and you want to learn a strategy that's got big upside potential. Now, as everybody and many of you know, here at TheoTrade, we offer monthly courses. The next class that we are offering is our VIX Volatility Spread course. And I throw this in right up front because I don't want anybody to be surprised. Trading VIX options. We're going to do a VIX Volatility Spread class. I will be the trade instructor. The class itself is this coming Saturday, November 18th. It's from 9 a.m. to 12 p.m. Central Time. Now, the class is recorded because immediately people, well, I'm not going to be available. Class is recorded. The class includes all the entry and exit criteria. And I'm going to be very clear tonight. You are going to learn a tremendous amount this evening. You will learn a strategy this evening, okay, that I think that hands down will be one of the best things that you've ever seen inside of Volatility Products, okay? What people come to a TheoTrade class for isn't just to learn a strategy. I will teach you that strategy tonight. What you come to a TheoTrade class for is entry and exit criteria. And for that is what people pay. I mean, the course costs $149. That's what people ultimately pay for, is a checklist of entry and exit criteria. Now, let's get into it here. Why do you want to trade volatility? It's a fair question, okay? And it's the question, and please, by all means, chime in. These are not rhetorical questions. You're sitting here watching this, maybe even on a archive. Why do you want to trade volatility? Do you intend to use these volatility products to reduce risk on a 401k, IRA, or stock portfolio? Okay? Or are you just trying to profit if the market tanks? I mean, it's a fair question over here. And I stress to you, okay, again and again, what are you trying to do? And it's important that you have some determining factor in your head saying like, oh, well, I'm trying to profit for this. Or you could say like a little bit of both. But how do you do both? If you have a 401k right now or an IRA, and I'll give you an example. You own a bunch of different stocks, a couple of technology stocks out there. Using a volatility product can help reduce the risk. And that's specifically what we're going to show. Now, again, a lot of people turn around and they reduce the risk of volatility. I'm not sure what you're saying. We're going to explain a lot about this. Okay. We're going to explain a lot about how trading the VIX and volatility product can actually, again, reduce risk of this 401k, IRA, or stocks portfolio. And I absolutely stress that. On the other hand, are you just trying to profit in the case equity markets decline and volatility is increasing? That's it. I mean, if the market tanks, let's just profit off of it because I don't have a big portfolio. Either or is viable. Okay. And when somebody said, can't we do both? Well, if you think about this, you're either protecting your butt, okay, or you're trying to make some money. How do you do both? Now, you got to think about that because that's the exact point that I like to make on this front. All right. You need to understand volatility. Now, this is a pretty key statement. whether you're trying to reduce exposure in the markets, right? And I was talking about reducing a 401k risk or profit from a rise in volatility. Literally, everyone involved in markets can and should have some finite understanding of volatility. And that's just, it's a huge blanket statement that if we don't have some understanding of volatility, okay, how do people go about? I mean, you can go out there like, well, I bought a stock. And what's the volatility on that product? And it's a blank stare over there. Well, volatility can help you in so many ways. So let's move forward over here, and I'm going to give you a little bit of foundation of that, okay? First, trading volatility products. Trading volatility products seems really straightforward enough. However, you ever viewed a product like the VXX or the UVXY over the last 3 years? Buying any volatility product is an outright recipe for disaster. Most volatility-related products have lost over 90% of their respective values in the last 3 years. Okay? And this is what I call the inevitability of volatility products. The decline of volatility products is inevitable, okay? As the products themselves are based on volatility futures, which decay. Volatility actually decays when you start to understand it in more depth. And this is where everybody's like, well, I could use the VXX and UVXY and the XIV. Okay, by the way, if you ever looked at the XIV is the inverse. Okay, the inverse. Very few people realize this. If there's a big spike in volatility in the markets, that means if the markets tank, that product can go bankrupt. And you're like, what? The product can go to zero overnight. And very few people realize that. Read the prospectus, right? So before I go any further over here, I'm going to give you guys the crash course in volatility because I think this is hugely, I guess, helpful. All right. So let's start with the idea of what is volatility. So here's a slide. It's an age-old slide I've been using, and I'll give you a kind of, an understanding of this. Let's say this is a stock and it's a $100 stock. Now, let's take the assumption you don't know whether the market's actually going to go up or the market's going to go down. Let's take that assumption. Fair enough right now? Especially right now. The market's gone up for what? Oh, I don't know, my entire life. All right, it feels like that. It's basically since, 2009. Buy the dip. But for the last just few trading sessions, we've had a little upward movement, a little downward movement, feeling a little bit uneasy over here. So you have this $100 stock. Now, every stock has this volatility associated with it. And volatility is always quoted in percentage terms. And that seems weird to everybody's like, why is it quoted in percentage terms? Well, again, tonight we're going to talk about the VIX. And the VIX is quoted in percentage terms. And the VIX lately has been around 10, okay, to 11. But if you ever look at the VIX, it's 10 or 11%. The VIX is always quoted in percentage terms because the VIX, okay, is volatility. So when you look at volatility and it's quoted in percentage terms, what does that really mean? It means 20%, exactly what it says. But that 20% is annualized. It equals 1 year of time. It's 1 year of time. Why is it 1 year? Because they just standardized it. So when you look at a $100 stock with a 20% vol, what it's indicating, what that volatility reading is, okay? Let's not even use the word volatility anymore, okay? It's a risk metric. It's just a risk metric. What is risk? Risk is 20%. That's why I put this together on the slide. What is, forget volatility, what is risk? Question mark. Risk is 20%. What does that even mean? It means the stock should go up about 20% or down about 20%. That means up about $20 or down $20, assuming it's a $100 stock. Now, it's supposed to stay in that range 68% of the time. You're like, oh, where did the 68% of the time come from? 68% of the time is what we term one standard deviation. Now, that's where you got to be like, oh, we're not in Disneyland anymore. But here, let me just show you. Everything you do in your life can fit into a distribution curve, right? Okay? Distribution curve. By the way, somebody said 20% of what? 20% of the stock price. That's what it is. Okay? 20% of what? 20% of the stock price. So whatever the stock price is, if the stock price is 200 and it says 20%, right? What's 20% of 200? You're like, boop, 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 boop. Okay? So on $20, it's $40, and so forth and so on. But again, it's supposed to stay in this range. And again, that range, it's a pretty big range, 68% of the time. And again, that's one standard deviation. So let's get to what one standard deviation amounts to. Everything you do in your life can fit under one of these distribution curves, right? There's like, and I love to use this analogy. There's like really, really good drivers up here. And then there's really, really bad drivers down here. And then LA is somewhere over here, right? Somewhere over there. Oh, come on. Do you tell me that is not a fair statement? It's Los Angeles, right? We've only got 1 or 2 people joining us from LA, okay? In New York, yeah, they can drive in New York, all right? Nobody drives in New York. That's why they can drive in New York. Anyway, by the way, if everybody's a really, really bad driver, then everybody fits into the meat of the curve. Some people are like, this is how I got through high school. Anyway, everything you kind of do can fit into the meat of the curve. But the volatility is considered one standard deviation, and it's supposed to account for 68% of all occurrences. So here's what this whole thing means, all right? And bear with me for a second because it's kind of crazy. When you look at the VIX, okay, and the VIX says 10%, like if the VIX is 10, it says that the S&P 500 should only be moving, okay, about 10%, either higher or lower. But there's an interesting irony to that right now. What's the interesting irony right now? Has anybody looked at the S&P 500? Okay, let's go. Let's go look at it. Come on. This is, you know, show it to me. Here's the S&P and the year-to-date percentage. The S&P this year is up about 14%. It's up about 14%. But the VIX, okay, let's go look at the VIX. The VIX on the year, and again, we can look at a 1 year, we can look at 2 years, we can look whatever you guys want. The VIX on the year, it's averaged somewhere here in the neighborhood of about 11 or 12%. That's been the VIX this year. Okay. Now, again, this is just some background stuff because, you know, at this point, people are like, whoa, man, this is, did I get intense quick enough? Because, again, I just want to make sure that everybody has a background for this before we actually teach some trades. Because how can you use this, right? How can you use this stuff? Well, hopefully, at this point, you realize that any product you look at has a volatility. You know, what's Google's volatility? It's about 20%. Okay. What's Apple's volatility? Yeah, it's about 20%. What's Microsoft's volatility? It's a little bit lower than 20%. What's Walmart's volatility? I mean, we can have a party going through all these, right? Okay. Why would I want to do that tonight? Because it's important. It's important. Like if you look at Walmart, Walmart has earnings coming out when? This week. Look at that. 42% volatility. Whoever would have thought that Walmart's volatility right now, that's Walmart's 42% volatility. It's a lot of risk, okay? Walmart's volatility is higher than Apple's volatility. Who would have thought? You know, you get like a tech stock over there. Walmart in the near term is looking more like Tesla. Okay, look at this. Tesla, 42% volatility for 3 days. You can't make that up. It's 42% volatility. Okay? Then we have Walmart. It's 42% volatility. So the next time you think Walmart is not so risky, well, now you understand a little bit about volatility. Why? Why would you want to do that? Let's say that you're position sizing. Okay? You're trying to, hey, I'm trying to trade Walmart versus what? Versus Tesla, versus 2 seconds later, I'm looking at Microsoft. And now you have a volatility comparison. You know, I showed you, whatever, the price of the cluster is $150. That alone, it's worth it. And I hope you guys realize, just tuning in tonight, it's worth your time to learn a little tiny nuance like that to help you position yourself. Now, hopefully we're okay. Everybody okay? It's okay. We can take time. We can breathe, right? I don't, but you should. Okay. I'm just making sure everybody's tuned in, turned on, because this is about to get deep. All right. Onward and upward. I got a couple. By the way, these are, again, they're not rhetorical questions. I read everything, okay? Everything that you guys chat in over here. Everything. So, and even if you're, at home watching this on an archive, okay? If we get questions in here, I'll answer them. And you're watching this 2 days after it happened. That's all right. Hopefully I'll have answered your questions because there's a lot of people alive right now that are going to ask those questions. With that, a little VIX background. The VIX itself started as nothing more like the VIX. It's the S&P 500 Volatility Index. Okay. It started as a calculation of the implied volatility of SPX options. Here's the funny thing about the VIX. Okay. It just started as a calculation. It wasn't a tradable product. Now, a lot of people don't know that. It was a calculation. Since its introduction in 1993, the VIX has been considered by many to be the world's premier barometer of investor sentiment and market volatility. They always call the VIX, it's the fear indicator. You know why they call it the fear indicator? Because the VIX is equivalent to what? Risk. Okay. And right now, ain't a whole lot of risk on the marketplace, which is strange. But in 2006, okay, options on the Chicago Board Options Exchange, the CBOE, they opened up VIX options and began trading on the Chicago Board Options Exchange. So in 2006 was the first time that anybody really started trading VIX options. That came directly from the Chicago Board Options Exchange. The VIX is an implied volatility index that measures, okay, the market's expectation of 30-day S&P volatility implicit in the prices of near-term S&P 500 options. Now, if you're reading that over there, you're like, what? The way that the VIX works, this is all you got to know. The way the VIX works, the VIX measures, okay, option pricing in the S&P options. That's it. The VIX measures option pricing. When people look at the VIX, let me boil it down to this easy. The VIX, forget about the word barometer. I don't like it. You know what I like with the VIX? The VIX measures supply and demand. The VIX measures supply and demand. Say it, okay? Why does it measure supply and demand? Because if everybody in the world demands options, the VIX goes skyrocketing. Right now, there's not a lot of demand. There's supply, meaning they're selling options, which creates a very, very low volatility. Now, with that, markets down, VIX up. One thing I want to explain that I think is critical for this presentation. Let's say that, again, this is the marketplace. Okay, the curve. Why do I use this distribution curve as the marketplace? Because at this point in time, I don't want to imply whether we're going to go up or whether we're going to go down. Okay? That's, again, what my market sentiment. I know people tune in to these webcasts all the time. Well, based on this indicator and that indicator. If you haven't figured this out yet, nobody knows nothing. If you haven't come to fruition with that, you got problems right off the bat. Because when I say nobody knows nothing, did you know the market was going to be down pretty good tonight? It is. All right. When I say the market's down good tonight, how come nobody talked about this? I mean, geez, nobody's talking about the fact that the S&Ps are already down big tonight. That's bigger than they were down all day. Okay. And yet it's tonight. And you're like, wow, I didn't know that. Okay. Assume, and even if you do have a good feel for markets and you're looking at, a MACD, a Fibonacci, a Bollinger Band, assume that you don't know what's going to happen. And assume that this is the S&P 500. Okay. Just assume it's the S&P 500. Now, if the S&P 500 goes down, this is down. Right now, the S&P 500, it's trading at 25, let's call it, and you just saw on the screen, right around 2570. Okay, that's where the S&P 500 is right now, about 2570. If it goes down hard to 2400, what does the VIX do? The volatility goes up. Now, why do I bother mentioning this? Okay, why do I bother mentioning this? And, a lot of people also look at the Dow. So let's talk about the Dow for a second. Okay, because when we talk about the VIX, most people think that volatility, if you had one definition for volatility, most people say volatility, what is it equivalent to, right? Well, volatility, it equals movement, Don. Well, but that's not true. It's not true. Volatility is not equivalent to movement. That's a secondary definition. Volatility, okay? Volatility is equivalent to what? Risk. Why? And it's all about risk. It's supply and demand. So how do I know this? Because I just said, if you look at the Dow, and again, let's assume now that this is not the S&P. Some people don't follow the S&P. Let's say it's the Dow. Let's say the Dow goes up. If the Dow goes up, where does the VIX go? You guys tell me. Come on, Dow goes up, where does the VIX go? Anybody? Anybody? These are not rhetorical questions. Jump in here anytime. Excellent. Down. Market goes up, volatility goes down. So then, if the market goes skyrocketing higher, which it did this year, especially in the NASDAQ, how can volatility be movement? It can't be, and it's not. Volatility isn't movement, it's risk. Remember this. Markets go down, VIX goes up. Why? Because when the markets go down, people demand something. And what do they demand? They demand options. They demand options. They demand, I need coverage. We okay? Because things are going to get interesting now. Now we're going to get to the myths of volatility. This is critical. Before we go any further, there's so many, I guess, areas of volatility that are misinterpreted that I actually had to come in here and I was like, I'm putting together a presentation and I'm like, wait a second. People are not, first of all, people go out and buy the VXX. You want to go buy the VXX? Look at this thing. Literally, you look at any volatility product over here, and I know I'm going off the beaten path, but you buy the VXX, this thing's on a crash course with what? That's just 1 year. Like, look, here's a year-to-date percentage. You can't make it up. This is live on a trading application. It's down 63% year-to-date. So obviously, you can't just go out and buy volatility, can you? That's one of the myths that's easily kind of busted. It's very, very easily busted. And somebody goes, well, if your timing is right, look at the UVXY. The UVXY is like double the VIX. What do you get? It's double death. It's a 90% decline in 1 year. Like you can't make it up. It's 162 down to 14. Yay. Even when the volatility goes up, the UVXY can still go down. It's crazy. So I thought it imperative before I go in and start teaching the strategy. Okay. Before you teach the strategy, you have to learn a couple of the myths about the strategy. So to move on, charting the VIX. Now, here is, to me, the single biggest myth, contrary, and you guys will appreciate this one, contrary to popular belief, looking at a chart on the VIX will not tell you when and where volatility will strike. Right? Looking at a chart of the VIX, the VIX is here. Let's go look at it. Okay. So you bring up a chart of the VIX, volatility is coming. It's not going to tell you. In fact, those charting the VIX should know that the equation used to determine the VIX has actually been changed, subsequently been changed several times. So here's a 5-year weekly chart on the VIX. And I wanted to have fun with this one because whenever you turn on right now, most of the media, they're talking about the VIX because everything that everybody's talking about right now happens to be, man, that volatility's low. Okay. These guys, look how low the volatility is. I'm aware that every major financial news media outlet shows charts of the VIX comparing volatility for the last 20 years. ... because it's the lowest volatility we've seen in 20 years. Well, somebody should tell them that the VIX most recent change in calculation came in October 6th of 2014. Go check it out. The calculation change was quite critical. Out with the old and in with the new. The new VIX calculation can differ from the old calculation as much as plus or minus 10% per day. So much for charting the VIX or comparing it to the past. Because all the studies, all the technical studies that are done on the VIX are absolutely, consequently wrong. The old VIX, by the way, can be charted with the symbol VIX-MO. It means VIX monthly. They totally changed how the VIX is calculated in 2014. I know this because I was working, at pretty much the largest retail brokerage firm. And when they changed the VIX calculation, we had to change all the calculations in the trading application. And it was vastly different. It's fun, isn't it? Okay. That was myth number one that I wanted to kind of bust over there. And it's important because everybody thinks that I know where that volatility is going, yet it's out with the old and in with the new. The next thing, buying calls, okay, and specifically call options in the VIX will make money. The second and probably most costly mistake made in the VIX options, traders buy call options assuming volatility will go up. I'm going to tell you right now, if you follow this logic, okay, it's going to be one of the most costly mistakes you ever make. Let me ask you something, okay, and I'll explain why here momentarily. Why? Okay? How many people have done this before? Because everybody's like, why? I need to know why. But how many people have ever done this? Buy call options on the VIX. If you buy call options in the VIX, assuming volatility will go up, you probably still lose money. Okay? In the VIX, there's no free lunch. Sadly, even when volatility goes up, call options may not. They may increase, but they may not drastically increase in price. Wild volatility swings are already priced into the VIX options, and buying calls can be a stark reminder there is no free lunch in these markets. Okay? Look, only one person was willing to admit to this one. How many people here have honestly ever bought a call option in the VIX? All right? Or VIX-related products. All right? VIX-related products, VXX, UVXY, okay? Because I'm going to show you a really interesting example right now. And this is a big time what not to do. And sometimes you got to show the what not to do to get to the what do you want to do right. Here's a Brexit VIX trading example. Here's an example, assuming you timed the purchase of the call options perfectly before Brexit. So I want to show you something in my example. I'm assuming that you did everything perfectly, which none of us are probably going to do before the Brexit. All right, what's the Brexit? It was just in what? All right, well, here we go. Here's the VIX Brexit example. And I really like this one because I answered a number of emails on this front right after it and about this trade, and it always stuck with me. Okay. This one, it still sticks with me. So on June 22nd, now let's all remember, this is a VIX Brexit example. Let's all remember that most assumed that Brexit was never going to happen, right? Everybody assumed like, oh, the vote, come on. Like 65% of the population does not want to exit the European Union. But let's assume that your timing was perfect in June 22nd, days before the Brexit vote. All right, June 22nd. The current VIX price, now the VIX, it came up a little bit. I mean, the VIX was hovering around 15, but it came up a little bit just before Brexit, just in case, right? Just checking, just in case. And you go out and you would purchase the 19 calls. Those are the at-the-money calls. You could purchase the 19 calls for around $2.90. Now, that's a real market. All I did is just went back in time, took a screenshot of it, took the current VIX price, and purchasing, again, the 19 calls, anticipating a rise in volatility. Now, here, there's 27 days in this trade, 27 days. Now, the very next few days, all of a sudden, shock and awe. People are like, whoa, I can't believe that actually happened. The VIX takes off to the upside. The VIX takes off to 22. Okay? Now, this is just 2 days later on the 24th. Brexit vote shocks the world. The 19 calls that were purchased, they were bought for $2.90, okay, do move up in price to a meager $4.80. Now think about this. One of the largest spikes in recent volatility history. And what would you have made? I'm not saying that you're not going to make money, but this was monumental. And you're like, yeah, if my $3 became almost $5. You didn't even make 100% on the trade. Do you think it's worthwhile in one of the most recent history volatility spikes? I mean, listen, This is perfect timing with poor results. The aforementioned example assumes, okay, near perfect timing on entering into the purchase of a call option in the VIX and still makes a minimal percentage return. Now think about that for a second, because this is what, like, if you're going to use the VIX options, whether it's the UVXY, whether it's the VXX, if you're going to learn this stuff, you got to learn, okay, the right way to do this, because this trade could have made 400, 500, 600%. And the problem is the right place, the wrong strategy. You have the timing right on the VIX, but you're completely the wrong strategy. And that's what we're here to really discuss, the right strategy for the VIX. What if we could kind of teach you a strategy whereby, okay, the out-of-pocket cost of the trade is zero. The out-of-the-pocket cost of the trade is about to be zero, okay? And you can make big potential percentage profits. Because we can use that exact Brexit example if you want. But here's the thing about the VIX. You might not know when it's going to go up. The VIX could go skyrocketing tomorrow, right? It could be what? Skyrocketing tomorrow. And by the way, I want to be clear about something. So in the previous example, you know, yes, you would have made money, but that's timing it perfectly. And I'm going to tell you right now, 60% is nothing when you're timing things perfectly. You got to hit it out of the park. All right. Again, the cost of this upfront and out-of-pocket cost is zero. You can make big potential percentage profits. And yeah, we're going to talk about the risk. Here's what you need to learn. There are several effective strategies in trading the VIX options, both to reduce risk, okay, and as a means to profit in a market decline. So I stress this, all right? You're either reducing risk or profiting in a market decline over here. We're going to bring up a strategy. We're going to talk about it. Okay, breathe deeply, because here we go. TheoTrade VIX Volatility Spread. The VIX Volatility Spread, okay, is an altered version of a spread that has been used and is being used by most of the major derivatives firms on the planet. Okay, and I'm going to explain what this comes down to. And yes, the out-of-pocket cost right now is zero. There is risk in this strategy. Listen, there is no free lunch, but the risk in the strategy pales in comparison to the upside potential of it. First, let me break this strategy down for you, okay? What we're doing is we happen to be buying, and again, this is buying a 15 call. What's buying a 15 call? When you buy a 15 call, okay? Let's say the VIX right now, all right? Let's say the VIX is at 12. So let's say the VIX is at 12. You buy a 15 call. Where do you want the VIX to go? Come on, quick. Where do you want the VIX to go? Buy a 15 call. A 15 call gives you the right to buy the VIX at 15. You want the call, like what? You want that call deep in the money. You want that VIX to go skyrocketing. 50, right? If the VIX goes to 50, it'd be beautiful, because what's a 15 call with the VIX trading at 50? You're like, oh, what is a 15 call worth with the VIX trading at 50? Oh, about $35. But let's say it's the VIX. Let's say the VIX takes off to the upside and goes all the way to 20. What's a 15 call worth with the VIX at 20? Come on, 15 call. What's it worth with the VIX trading at 20? It's worth probably what? $5. That's worth at least $5. Now, simultaneously, and I'm going to blank the screen for a second, at the same time as that you're buying a call, you're also selling a call. That is what we call a spread. You're buying the 15 call and you're selling a 19 call. Now, why? Because it offsets some of the risk. It also offsets some of the price. Now, what's the difference between 15 and 19? The difference of the spread, okay, is $4. What's the most you can make on the spread? $4. So what happens here, you have the right to buy. You have the right to buy the VIX at 15. Everybody else in the world, what? If the VIX goes skyrocketing to 20, they would have to buy it for 20. But you've given somebody else the right to take the VIX from you at 19. So you have the right to buy the VIX at 15. Everybody else in the world can what? Take it from you at 19. But what do you care? All right. Let's say the VIX goes skyrocketing even to 100. Well, you buy the VIX at 15. You have to give it to them at 19. What do you make? $4. What's the most you could possibly make on this spread? $4, $4, $4, $4. You can't make more than $4 on a $4 wide spread. Okay. You cannot make more than $4. So some people go, I don't like it. My risk. Okay. What is my risk? We're going to come to that here momentarily. But some people don't like it because their profits are defined. Yeah. What don't you like about the fact that you what? There's no upfront cost. And the reason that there's no upfront cost, we're actually selling a VIX put to finance the cost of the spread. Whoa. So the VIX right now, let's say the VIX is at 12. The VIX is at 12. You're selling. That's selling an 11 put. Now, for those of you, if you're curious about margin, it's fairly minimal. You can sell the put, and I will come to everything. And some people go, what about the margin is selling a naked put, but still my heart. This trade is less than $500 a margin, period. This trade has less than $500 a margin. It's a very, very minimal risk trade. Some people say, I don't have the option ability to do this. Yes, you do, because we can get that for you. And I can even teach you ways around, okay, around margin in this trade and around option capabilities. And say option capabilities, some brokerage firms will tell you, you can't sell a put. Yes, you can, because I can teach you a way to do that. I mean, that's a huge portion of this, right? So let's talk again, though, about the risk. You're selling an 11 put. The VIX right now is at 12. You sell an 11 put. What do you sell it for? You're selling it for $0 because you're taking the profit from what you're selling the put for and investing that into the spread. But what happens if the VIX, okay, goes to 11? What's an 11 put worth when the VIX is trading at 11? Well, the VIX 11 put when the VIX is trading 11 is worth $0. What if the VIX goes down to 10? Ooh, what's an 11 put worth with the VIX at 10? Ruh-roh, okay, you're going to lose $1. What if the VIX goes all the way to 9? By the way, the lowest print in the history of the VIX, the single lowest print ever in the history of the VIX is 9.1. That's the option settlement. The option settlement, 9.1, has been the lowest print ever, in which case you would still lose less than $2. Now, here's a strategy that if you actually look at the prints, and I'm showing you what the risk is, okay, a VIX print lower than 9 has never happened before. And yet we have low volatility right now. In fact, if you ever want to look at this, okay, the VIX, when I say prints, forget the VIX itself. You're like, but Don, it says the VIX was at what? Listen, this is the lowest recorded VIX was $8.84. But that's not the VIX settlement. The VIX settlement is under symbol VRO. And the lowest VIX settlement ever was 9.1. And you can look back as far in time as you really want. That is the lowest VIX settlement in the history of the product. And it just came recently. So your risk in here, you're like, if the VIX goes to 0, wait, the VIX can't really go to 0 because of the volatility index. The lowest VIX has ever been is 9. Why aren't more people doing this stuff? They are. Before I go any further in this strategy, I made a bold statement. Why aren't more people doing this stuff? They are. Have you looked at the VIX options? Okay, let's go look at the VIX options here for a second. Let's look at all the options. And I'll take you for a minute. I'm going to customize this, and we're just going to look. Yeah, you know what? We'll look at volume and open interest. And I want to show you, when I mean volume and open interest, the number of open contracts. Do you think it's strange that 200,000 contracts are opened right there? By the way, I have a position there too. Okay? You think it's strange that there's 500,000 of the 15s in here? That's 500,000 contracts. Okay? Wait, it gets better. It gets better because here's the mother load. The mother load of all contracts. One of the largest trades ever done. They keep calling this the mystery trader. It's not a mystery trader. Everybody knows who this is. There's 800,000 contracts. This is a volatility firm. Okay? They've been using this type of a strategy. They use a very small variation. Their variation takes more margin. It does. It takes a lot more margin to do their variation. But you can see decisively this exact strategy is being utilized by a ton of different firms out there. Okay. And I'm telling you right now, what this strategy breaks down to, generally speaking, you are risking, okay, and I'm being very forthright over here, you are risking 1 to make about 4. And you're not going to make the 4 all the time because the VIX has to go where? Has to go up. So you might lose a buck. But you know what? Make 4. Extraordinarily worthwhile. And a lot of the times the VIX, it might just close at 11, could even close at 12. Look at the risk reward in here. Look at the risk reward in the risk graph over here. Again, the VIX has never closed below 9.1 on a settlement, creating a minimal downside risk. That's why that line is there, because that's also substantiating your risk, right? It looks scary until you realize this product, it can't go to 0. If volatility goes to 0, there's no reason to have a marketplace anymore. It's all over at that point. So you have a wall standing between you and a lot of risk. But at the same time, look, one contract in here can make as much as $400. And there's not a huge amount of margin being tied up in this thing. Minimal risk, massive reward. Minimal risk, massive reward. That's what the strategy. And I told you, I'm going to teach you one real strategy in here. By the way, there's variations of this as well. I mean, go into some of the characteristics of the VIX volatility spread. The attributes of the spread are undeniable. Think about if you could go out and risk 1 to be able to make 4, what you could do in terms of controlling risk of a 401k. I mean, forget for a second about profit potential. Okay. You could really control a lot of risk very, very easily. Like, you don't have to trade 1 contract. You do 10. 10 contracts, okay, can reduce risk of an account by up to $4,000. That's just 10 contracts. You know, somebody in here is going to be like, well, I want to do 100. Good, do 100. It's $40,000 of risk reduction. All right? Think about that. The VIX volatility spread can work in down, neutral, and even trending bullish markets. Even if the market's bullish, right, you have about a 60% probability of not losing anything. There's about a 60% probability that the VIX closes at or above 11. Now, you could just look at the probabilities behind this stuff. Okay. When I say you can look at the probabilities, you can look at the VIX. You can open up the VIX options. Okay. And there are ways to calculate what we call probability. The probability this option is going to be out of the money, well, right now is about a 55% chance, okay, that option is going to expire worthless. On average, it's about 60%. So if you look at the VIX itself, okay, if you're looking at the VIX itself, you know, the probability of it being right around that 11 is about a 60% probability. Solid. Again, it can work in down markets, neutral markets, and trending bullish. And I'm repeating that because if the market goes down, if the S&P goes down, clearly the strategy makes money. If the market's flat like it is right now, you're fine. Okay. But in trending bullish markets, you're not going to get killed. And you're paying nothing upfront for the VIX trade. Okay. You never have to buy a stock or worry about options assignment risks. That's something I didn't even mention about the VIX. There is no underlying to the VIX. So you don't have to worry about the VIX. I sold an 11 put. They're going to put me the VIX. There's no VIX to put you. It's a cash settled product. If you lose $1 in here, they just take $1 out of your account. Your risk is minimal. You don't need stop orders. And it's an excellent tool for those seeking returns to build a smaller account or a 401k. And I stress the 401k because, you know, people are going to watch this. Oh, yeah, I can do that strategy. You think it's not worth $150 to go to a class to learn, okay, how to reduce risk of even a $50,000 401k? Building, okay, the VIX volatility spread. Don't let options intimidate you. That's something, you know, I mention this all the time. Do not let options intimidate you, okay? You got to learn a couple of the basics of options. We can do that. It takes a few hours. But this spread, you know, the analogy I give you, the spread's a massive chainsaw. You're going to go out and you're going to cut down a tree. If you're going to cut down a tree, you can use a handsaw, but you're probably going to get it done faster with a chainsaw, okay? The chainsaw is going to be the quickest, the fastest, probably even the safest way to do things. Like cutting down a tree could be dangerous, but used incorrectly, probably going to cut off a couple of fingers. And the exact same is true, undoubtedly, though, of these VIX and these VIX options. Used correctly, extremely effective in creating returns. Incorrectly, you're going to cut off a couple of fingers out there. And again, I can't stress enough, the VIX, like, I'm trying to find a strategy to reduce risk, to give you profit potential, and to do it for nothing up front. It's pretty critical, right? It's pretty critical over there. And again, fear not the VIX Volatility Spread. If you don't know much about options, fine. We'll show you how and when to place a VIX Volatility Spread in a matter of a few hours. Okay? What we do, and I mentioned this right up front, this is what we do here at TheoTrade. Detailed recipes for every strategy. Obviously, we're going to do a detailed recipe for the VIX Volatility Spread. And, we just showed you what the cake was. Okay? What we charge for the class for is the recipe. You do not trade without a recipe. And as I show you this, a little bit more about this, why doesn't everybody do it? Because you need the recipe. You absolutely have to have the recipe. And I know that some people are going to take this exact trade. Okay? You can take the trade right now and you can replicate it. You can replicate this exact trade right here, right now. Listen, the strikes are there, the months are there. But one thing, you're not going to be able to reverse engineer when to get out of it. You'll lose more than $150 just learning how to execute the trade effectively. There's execution risk in here. When I say execution risk, how do you send off the order? There are so many ins and outs of this spread that you need to know. And that's why in a presentation like this, we show you everything about the strategy. Again, you come to the class to learn the recipe over there. But why doesn't everybody do it? Because you have to determine the trade setup. What expiration do I select? What strikes do I use? The position sizing. Position sizing is huge. If you have a $100,000 account and you want to reduce risk, how many contracts to use? What's the correct probability for the trade? Execution risk. I just talked about that. Executing. Eventually, you got to hit send. Sounds easy enough. Okay? When do you exit? It's a pretty big question mark. What do you do in a losing position? There's all these odds and ends. And that's simply why everybody doesn't do this over here. And what we do at TheoTrade is we create recipes. Trading really comes down to answering the what ifs. The markets rally, if the markets tank, you do in losing position, what strike prices do I use? The VIX seems like such a daunting task. But if I gave you 7 steps to walk through, okay, you'd be able to put on one of these VIX volatility spreads like it was nothing. You'll even figure out how much capital to be able to commit. And we'll answer all these trading questions. There's not going to be a what if left. The right probability for the trade. All right, when do I close this thing? If the market sells off big, if the market sells off big, yay, I'm profitable. But when do I get out? What's the correct return for it? What if the markets rally massively? Can you fix a losing trade? Can it be done in an IRA or retirement account? I'll give you that one. The answer is yes. We got the answers to all of these because that's what the recipe for this class ultimately does. Each unique variable that you're encountering, okay, is answered in there. The how, the when, the why, at what price. It's just the beginning. That's just the beginning of some of the variables you're going to face while buying a VIX volatility spread. Okay, the secret's always going to be in the sauce. And again, everybody, I can read about these VIX volatility spreads. The funny thing is, the entire trading world, okay, the entire trading world's talking about this strategy, and yet they don't have it correct. By the way, somebody was talking about margin in here. Yeah, we'll talk about margin. Okay, no problem whatsoever. We can even teach you to reduce margin. That's something you're going to go to the class for. And I hope that's all right. We're going to give you just enough to make you incredibly dangerous. Okay, but we spent months fine-tuning this trade setup and criteria. It's actually, this is an age-old strategy. It's the right time to teach this class. And if you want the criteria to the VIX Volatility Spread, trading options, all right, the VIX course. It's Trading the VIX Options course. I'll be the trade instructor. And I call this spread the VIX Volatility Spread. The class is coming up November 18th, 9 a.m. to 12 p.m. Central Time. All the classes are recorded. And the class, it includes the entry and exit criteria. And right when you come to the class, you can just download the checklist. That's one of the most important things. Of course you want to go through the class. Okay? In addition to the class, now this is unique. And we have never done this. And everybody always says that on some, webcast over there. We have never done this before. This is going to be very, very unique. You think the class is not worth $149? By the way, the web address, TheoTrade.com/vol. Again, TheoTrade.com/vol. But I'm going to show you what we have never done prior to this evening here at TheoTrade. The class itself, that's the live date. If you can't make it, you will be able to watch the recording instantly. Okay, the second that the class is happening, it's recording it in real time and you can play it back instantaneously. Okay, the archive will be posted directly after the class. In fact, after part 1 is done, after the class is half over, we even post the archive. The slide deck is available for you. okay, before the class even starts. Now, in addition, we are giving Options 301, Volatility and Expected Moves. It's essential that you watch that. Pay the $149 tonight and start watching the class tonight. In addition, okay, and this is a brand new one, this is Volatility's Futures class. It's an intensive 3-part series on volatility to prime you for this, to understand volatility futures. It's pretty intensive. Now here's the part that I said we ain't never done before, okay, and that's this. Included in the class itself for $149, we're giving you a 1-month access pass to TheoTrade. Some people are like, I don't even know what that is. We're giving you 1 month to TheoTrade. And I'm going to explain exactly what it is, because the class, easily worth $149. I'll tell you what, just the bonus here is worth $149. And when you start to put a price tag, again, I know that people are going to go out and they're going to try to poke holes in the trade. A couple of you guys have already copied the trade, okay? Do not execute this trade without having gone to the class. You will lose more than $149 in 2 seconds on a trade without seeing all the nuts and bolts behind it. And I stress that to you because they're like, yeah, I'm going to go play around with it. It can't be that bad. It can be. There are thousands of different trades that you could build inside of the VIX. You have to know, okay, what and when to execute. So in addition to the class, we're going to give you a 1-month access pass to TheoTrade. It's not a membership, okay? We're just giving you 1 month to TheoTrade. By the way, the course can also qualify you for a reduced commission rate. That's on the side. You want to know the commission rate? Just email us. We do not, okay, make that widely known on any public broadcast. There's a reduced commission rate. If you are specifically at TD Ameritrade, we have a wonderful reduced commission rate for you. What's much more important, which will save you and make you a lot more money, is the 1-month access pass to TheoTrade. Again, what is it? Well, let me explain exactly what it is. Okay. First of all, TheoTrade.com/vol. I will bring up the site in just a minute. This is the curriculum for the VIX class. Let me explain the curriculum for the VIX class, and then we'll get into what a 1-month access pass is. We're going to talk about how to use VIX options, risk 1 to be able to make 4, minimize risk. Okay. We're going to show you the exact same trade many of the professionals are using, but we're also going to show you there's an additional portion to this class. Is how professionals gauge overall market risk. And it's not by looking at the VIX. Okay? It's using VIX options to price overall risk. We're going to give you the entry and exit criteria. Okay? You're also going to learn how this is a set it and forget it strategy. You don't have to continually monitor this. It's perfect for traders who can't watch markets all day. Trading the VIX options with minimal risk. Okay? Learn how this is going to reduce risk of a retirement account. Protect, please. At the very least, protect a nest egg. Okay, you can substantially reduce 401k, IRA, or long stock portfolio with this VIX option strategy. So, if the market tanks tonight, be able to sleep at night. We'll show you the strike prices. And again, this can be done with a small account. All right, so the margin of the trade I showed you was right around like between $400 and $500, depending upon what strikes we selected. That's the margin on the trade. Anybody is going to be able to do this trade. Okay. We'll show you again the strikes, and of course, there's an on-demand recording of it. Now, let me get to the interesting part. Okay, there's a TheoTrade 1-month access pass. Now, what do we do at TheoTrade? First, the 1-month access class. It's included in addition to the VIX options class. Your VIX options course includes a 1-month access pass. It's everything we will do for the next month and more. Like everything we're going to do for the next month. For those of you that don't know us, we broadcast 5 hours a day. You're like, I can't watch stuff live. That's fine. It's all recorded. For the next month, you have access to all the coaching sessions, all the live trading sessions, daily coaching sessions, timely topics, stocks, options, and futures. It's a live trading chat room. You want to see what we do? And you want to trade live with us? If you want to put some VIX spreads on, we will be talking about the VIX this week, even before the class. Okay, you sign up right now for the class. Okay, come on. When I say come on, when you say sign up for the class right now, sign up for the class right now. Join us inside of the room tomorrow. Okay, and tomorrow I will specifically be talking a bit more about this. It's TheoTrade.com/vol. So I can't stress enough. Like, what else does it do? So we have a live trading chat room. We're doing about 5 hours, okay, per day in there. All of that's archived. You will have access to everything. There's real-time market insights. There's real-time trade ideas, okay? It's not just me. It's Tony. It's Doc, all right? It's Corey. I mean, it's Slim. It's Jeff Bierman. Instructor and coaching archives. You will have full access to all the instructor and coaching archives. If you miss something, okay, you miss something today, tomorrow, the next day, we're even broadcasting the Friday after Thanksgiving. You can watch all of those archived. There's also a start here selection. I'll argue something all day long. The start here selection, that's worth a few $1,000. There's all these basic introductory courses. You may know nothing about this business. You're going to come into our chat room and be like, what is going on? Whether you're a new or experienced trader, there's 22 videos you're going to get started right away with, okay? There's also emailed trade ideas, and we'll give you access to TheoTrade proprietary indicators. Enough, okay? It's tremendous what we're actually doing in here because, again, we want people to learn this business. I mean, I know that sounds kind of crazy, but we want people to learn this business, and I just can't stress that enough. And I'm going to pull up the actual web page over here and show you a couple of different aspects. So bear with me here momentarily as I do pull this up. Again, the web address is theotrade.com/vol. That would take the page. You can actually come over here. But in addition to it, you want to know what TheoTrade looks like a little bit. Like, what are you gaining access to? So we'll come in here to the member home. We'll sign right in. When I say the start here menu, you have access to this. Options 101. Okay. Options 101, part 1, 2, 3, 4, 5. Options 201. Options 301. Okay. Preparing for your trading day. Order execution, part 1, 2, and 3. Crash course and option Greeks. These are just some of the archives. What products to watch and why. Okay. You want to really see the archives in here? Here's the member chat room. Here's the member chat room. This is shared scans and studies. All the proprietary indicators we use, they're there for you. Okay. In the archives, check out the member coaching archive. This thing is broken down by month. But you're like, I don't even know what I want to look for. Go to the member home. Okay. Go to the member home. You can search for any topic. Any topic you can dream of is in here. All right. Just type in the word spreads. Like what kind of spreads? I don't know. Just type in spreads, credit spreads. Okay. Coaching session, risk twist spreads. Okay. And it goes on and on and on and on and on. How much is in here? Okay. And I'll tell you right now, for a month, you're like, well, that sounds pretty cool. I think I can handle that. It's a little overwhelming. But again, for $150, you'd rather be overwhelmed or underwhelmed. And we want to wow you. We absolutely want to wow you. Now, let me answer a couple of questions that have come up in here. Okay. And again, there's no reason for $150 that anybody shouldn't take this. You're like, well, I don't have the time every day. That doesn't matter. You can listen to 2 hours of archives over a weekend. The VIX class alone is worth the $150. We're just doing the other thing to really introduce you to what TheoTrade really is. Okay. And it's important to us. And by the way, you are not signing up for a membership. Okay. This is not signing up for like a big membership over here. So everything that we do, all access pass, every coaching session, every archive, every coaching archive we've ever done. And it's a TheoTrade 1 month access pass. Okay. And you can actually search, for me, for Doc, for Jeff, for Tony, from Slim, for Corey. All of us have actually done stuff in there. Now, again, I'm going to throw a few questions into the hopper over here. I'm going to answer a few for you guys, and we'll kind of move onward and upward. Again, it's theotrade.com/vol. And yeah, I want people to come to this thing. By the way, you can hop in the chat room literally tomorrow morning. We start every morning about 10 minutes prior to the market open. So wherever you live, you're East Coast, it's 9:30. Well, we start at about 9:22. Central Time, it's 8:22. Okay. If you can't make it, don't worry, it's recorded. By the way, the first question actually came in from Jack. I can't make the live class. Will it be recorded? Yes, everything is recorded and instantaneously archived. Okay. The class is completely in our chat room. It is all ultimately online. Now, Mitchell had a question. Could never get my head wrapped around options. Will I be able to follow along the class? Absolutely. In fact, to further the answer to that question, because a lot of people are a little nervous, like, all right, I'm not sure if I totally understand this stuff. I'll remind you, we're giving you an access pass. So come in here to start here, because it's a little overwhelming. If you know nothing about options, look at all the archives, 101, all right? If you've heard our options 101, and a lot of people have heard our options 101, you will find it, okay, a game changer. We will take you from the absolute basics, okay, to the extremes of this. All right, moving on. And again, I hope that clears the question there, Mitchell. You know, if you can't get your head wrapped around options, all right, I will beat it into you day in and day out. So, okay. Next question that's come in over here. Oh, let's go over to Richard. I can't get approved for options because I'm a newbie. Will your class help me get approved? Absolutely. If you're having trouble getting an options approval, we can help with that. No problem. No problem whatsoever. Okay, so we can help you get the options approval, and email us on that front. And again, I'll show you how to reduce, all right, your options approval, meaning there's a workaround for options approval, and I will show all of that during the class, because somebody says, I can't sell a put. No problem. No problem. We can actually work around that over there. Somebody says, all right, I can't make it on Wednesdays. Just start on Wednesday. Okay, the class itself happens to be, okay, on this Saturday. Now, if you sign up right now, you know, at theotrade.com/vol, it'll take about a half hour for our system to authenticate you. And from there, you're in. And you could actually start watching the archives tonight. You're like, somebody was joining us from Portugal. You ain't sleeping tonight anyway. It's already 2 o'clock in the morning over there. You're not sleeping, so just go for it tonight. You start watching the archives tonight. Seriously, you'll be impressed. Okay, no, you'll be shocked how much is in the archives over there. Literally shocked. So, Richard, I hope that answered your question about getting options approval. I like this one from Allison. I have a 6-figure retirement account. Need to make income, okay? But more importantly, Social Security doesn't cut it. Can this help me, okay, hedge my retirement? By the way, for those of you that don't know what the word hedge means, hedge is a risk reduction. That's what this class is about, Allison. This class is actually about risk reduction. It's about reduction of risk. And I'm going to talk about 401ks and IRAs, but the same trade can be used for profit and or risk reduction. And that's important, okay? And to clarify, because another question actually came in here from, look at Stephanie. Stephanie had a question. Is it a membership or a one-time charge? The $149 is a one-time charge. It's a one-time charge. That's important. We want you to experience, okay, what we have. And again, it's amazing what we have. By the way, does the 1 month access give me access to everything I would get, okay, in TheoTrade? And the answer to that is we have classes that happened over the previous 2 years. You do not have access to the classes. You have access to every coaching session. You can look back in the archive 2 years ago. 2 years ago, you look back in the archive to coaching sessions, okay? You can't get the full-blown classes. So that's important. But you can go back there and listen to coaching sessions. And I think the coaching sessions, that's the proof is in the pudding. And those things are awesome, okay? We will provide you, okay, how after signing up for the class, we will provide you a specific instructions to reduce your commissions if you are with TD Ameritrade. You don't have to be with TD Ameritrade. It's fine, okay? So, by the way, I suggest, somebody asked a question, if I sign up now, it's 30 days access, ends 30 days from today or 30 days from Saturday, okay? It's 30 days from the time you sign up. But I actually suggest sign up now. Get the primers before the class. Sign up now, get the primers before the class. 3 days, okay? It's going to hurt you, not help you. Sign up for it immediately. And don't worry about the 3 days, you know, for that, Ned, because I think that's a great one. So, by the way, again, tomorrow, if you want, you can come into the chat room and we might be firing over your head a little bit tomorrow, but that's all right. Okay. I mean, it's good stuff over there. All right. 1 or 2 more questions and we are going to call it an evening over there. By the way, I purchased the previous classes. and I'm loving it. Thank you, Charles. I kind of appreciate that. It's awesome feedback. With that, I'm going to call it a night. Again, TheoTrade.com/vol. I stress to you, listen, we've never done the 1 month access pass. That alone is worth its weight in gold. You got to realize over the next month, how much we do in a month is going to shock you. Okay. And it's overwhelming. It's good. You've got the archive. You catch up. You know what? Don't watch one football game. Okay. Don't watch, one Christmas special coming into December. Spend 3 hours. Okay. Listen to some of the archives in there, because I'm telling you, it will change your entire view of the market, change your life. TheoTrade.com/vol. My name is Don Kauffman. Thanks everybody for joining us this evening, and hope to see you in the chat room tomorrow morning. Have a great evening. Bye-bye.